뉴욕나우. 글로벌 시장에서 통하는 투자법을 알려드리는 뉴욕나우 한국경제신문 뉴욕특파원 강영연입니다. 오늘은 리처드번스타인 어드바이저스의 댄 스즈키 차석 CIO에게 미국 시장 전망과 유망한 업종에 대한 이야기를 들어봤습니다. 뉴욕나우에서 지난해 9월에 스즈키 CIO랑 인터뷰를 했었는데요. 그때 에너지, 금융주를 추천해 주셨었습니다. 이후 시장이 어떻게 흘러갔는지는 제가 말씀 안 드려도 다들 잘 아실 테고, 거시 데이터를 바탕으로 해서 시장을 정확하게 예측하는 전문가라는 평가가 허명이 아니었구나라는 생각을 하기도 했습니다. 물론 과거의 성과가 미래의 성과를 담보하는 건 아닙니다. 오늘 인터뷰에서는 먼저 올해 시장 어떻게 보시는지, 그리고 여전히 기술주에 대해서 거품이라고 생각하시는지, 그럼 대안은 뭔지, 지금 같은 인플레이션 시기에 투자자들이 어떻게 대응하면 좋을지에 대해서 이야기 나눠보겠습니다.
Yeah, I think people should brace for more continued volatility. When we look at the markets, we think that the biggest, most important driving factors are profits, liquidity, and sentiment. So as you think about this year, profit growth is slowing, liquidity is tightening, and we know that sentiment valuations are very high, and they have been high. So that combination typically leads to quite a bit of volatility, and that's what we've seen so far this year. I think it's very possible it will, but I think it's going to depend on a few different sort of tug of war dynamics that are happening in the markets. I think the first tug of war is between what we view as the bubble part of the market and everything else. That tug of war between those two parts of the market. And then the other major tug of war is going to be, the tug of war between the Federal Reserve and inflation. And so depending on how those play out, at the index level, it's hard to say definitively whether the market's going to end the year up or down. But I think those will be sort of the driving factors. So we actually care less about, where the S&P 500 or the overall market is going to end up, but really about, thinking about those two tug of wars. So, we're less concerned with the S&P 500. We care more about, whether we want to have exposure to the bubble assets, which we don't, or the rest of the market, which we think will actually end the year up and have very strong returns. So it depends on what part of the market you're looking at when thinking about whether you're going to see gains or not. Yeah, I think we may have talked about this last time, but we think the bubble is in, however you look at it, technology, innovation, disruption, growth, long duration equities. I mean, there's lots of ways to describe it, but essentially those expensive and crowded areas of the market. Yeah, I think there's a lot of headwinds to the tech sector right now. I mean, first of all, the fact that they're in a bubble, is a headwind for them. The starting point where people's expectations and the valuations is very high. So there's a very high bar to meet. And when you think about it, I think, what we're seeing this earnings season, I think is very important because, what's embedded in these high valuations is this sort of extrapolation of the growth that you've seen from these companies over the last, 5 to 10 years, which has been very, very strong. And so people expect that to continue on for the foreseeable future. And I think the other expectation embedded in today's valuations is that the idea that all these new companies can be winners in some form or another. And I think what you're finding this earnings season is evidence that calls into question both of those things. So, the perpetual growth at the rate that we've seen is probably unrealistic, going forward. And that's kind of what you're seeing in some of the earnings results. And then similarly, one company's gain may turn out to be another company's loss. And so it's going to get a little bit more competitive. And I think, so not all these companies can be winners. So I think that's, a big factor. And you mentioned, interest rates and liquidity tightening up. And then the last sort of, headwind, and there's more, but the last big headwind is the fact that, growth is slowing. As I mentioned, people forget that these companies are cyclical. If we're going into a slowdown, you'll see slower growth in phones, slower growth in software licenses, slower growth in tech investment. And that's what you typically see outside of a pandemic. That's what you typically see. So the combination of all these headwinds, I think, makes it very difficult for these stocks to to put up really strong returns, that the strong returns that people have gotten very used to. Yeah, absolutely. If you think about those sectors, I mean, just this year, it's a tale of two markets, kind of what I was mentioning before. The tech sector stocks and all those related companies are down a lot, whereas energy and financials are the best performing assets. I think energy is up, around 20%. Financials are around zero, which is actually pretty good relative to the overall market. So I think those are still the opportunities, and part of that goes back to the bubble discussion I was talking about. When you have bubbles, it creates too much money and going into one part of the market. But that means that money is coming out of other parts of the market. So you have underinvestment in other parts of the market. And that's the opportunity, because, these are cheap opportunities where it's not just that they're cheap. If you look at the earnings growth expectations, a lot of these companies are going to put up much, much better growth than is expected for the tech sector. The tech sector, communication sector, they're expected to put up, either middle of the pack or lower end of the pack in terms of earnings growth this year. And you're paying a lot, in terms of valuations for, what I would view as sort of mediocre to subpar growth. First of all, you mentioned the point about the economy, the U.S. economy being, much more geared toward consumption. And that's absolutely right. Most people talk about it being around 70% of the U.S. economy. So clearly the consumer matters a lot. What's interesting is, we're less focused on, the economy and more focused on corporate profits, because that's essentially what you're investing in, when you buy into the stocks of these companies. So corporate profits matter more. And when you look at the composition of corporate profits, it's much less geared toward consumption and much more geared toward, business to business investment, exports, capital expenditures, and things like that. So that's, something to consider. But, to your question about, what is consumption growth going to look like this year? I think it's going to slow. We're coming off of, tremendous, as you mentioned, we're coming off of this period of tremendous stimulus. And with that stimulus slowing, it's likely that that's going to result in, slower consumption. That being said, I don't expect it to fall off a cliff. I actually think that, there's a lot of reasons to believe that consumer trends will continue to be pretty healthy. First of all, they still have a pretty strong, sizable cash cushion. If you look at the excess savings, that were sort of built up during the pandemic through all the stimulus, the consumer is still holding on to a lot of those savings. Now, it's not across the entire income spectrum. Probably the lower income consumers have used up a lot of those savings, while the higher income people are still holding on to them. But that higher income cohort, makes up a greater portion of overall spending. So I think that, there is still a big savings cushion. And on top of that, people are getting, wage increases at a pretty high rate, and their overall, they feel better about their wealth, because, their real estate investments, their home, those prices have gone up a lot. And the stock market, as we know, even though it's come down a little bit, is still really strong. So if you put all that together, the consumers got a lot of wealth. Its balance sheet is actually quite strong. And it's still, so there's even a lot of room, because if you think about, credit card debt, which is what people rely on as they start to use up their savings, credit card debt was paid down so much during the pandemic that there's still a lot of room to build up, that credit card debt before we start to worry about a big fall off in spending. So for those reasons, I think that you'll see healthy but slowing consumer growth trends this year. Yeah, I think that for the time being, I think that, the outlook for economic growth looks healthy. I think it's hard to look out, beyond this year and say definitively whether there's going to be a recession or not. But I think there's still a tremendous amount of momentum in the economy here. And so if you look at what economists are forecasting, they're looking for growth to slow, real GDP growth to slow from about 6% to around 4% this year. So it's a slowdown. But if you put that 4% into context, we spent the last 20 years averaging around 2%. GDP growth. So you're talking about, a slowing to a growth rate that's, essentially double, the average of the last 20 years. And at the same time, it's not just about real GDP growth. If you think about, I said that profits are more important than GDP, profits and the economy are nominal. So if you see these higher inflation pressures, that's going to boost, the nominal earnings growth. So you could see nominal earnings growth at 7 or 8% growth next year, which I think is pretty healthy. So I think overall, you will see some slowing, but I think it would be hard to see, a recession, by the end of this year. Yep, that's
Yes.
absolutely right. Yeah, it's a really important question because you use the term normalize, and I think that you have to expect that inflation numbers are going to start to normalize, and they'll probably start to normalize, in the next quarter or so. So we're basically looking at 7% inflation, which is the highest in 40 years. It's hard to imagine that's going to stay at these levels or go up from here. Most likely you'll start to see that come down, in the coming quarters. But I think that people focus way too much on what inflation has done over the last 12 months and what inflation, that headline inflation is going to trend, how it's going to trend over the next 6 months. I think if you step back and think about where we are, I think the underlying trajectory for inflation is going to continue to be higher. So while use your words, we'll normalize lower, but then the trend in normalized inflation will go higher. And this isn't something that's unique to this cycle. I mean, you pretty much see that in every economic expansion. The later you get in an economic expansion, the tighter the economy gets. And that's why if you look at the history of cycles, you start to see inflation pick up in the latter part of every cycle, which is why the Federal Reserve starts to get worried about inflation and starts to, raise interest rates. So this is all very normal, but I think that's what people's expectations should be. People should not be expecting, as you start to see that headline inflation number come down, that's going to keep coming down. I think it'll come down to a sort of a normalized level, and then it'll start to go up again. And I think that will show that the underlying secular trend in inflation is probably still higher. No, I think that's probably too low. If you think about, what I mentioned earlier about, sort of the underlying inflation rate, if you think just a couple of years ago, before the pandemic, we were well above 2% in terms of the trend. And then we sort of went into a global slowdown that went into a pandemic. And then so those inflation pressures abated. Now, where we are, I think that you're going to start to see those inflation pressures continue to pick up. And so, it's unclear where exactly it's going to be, but I would be surprised to see us end the year below 3%. If we're in an inflationary environment, a period of rising inflation, people have to recognize that we haven't been in that environment, for the last 30 or 40 years. So most of the data and analysis that people are doing are kind of irrelevant. So it actually changes what the definition of a risk asset and a riskless asset is, because up until now, long-term treasuries were, it's commonly used as the risk-free rate. It's commonly looked as a risk-free asset, but in a rising inflation, rising interest rate environment, these are some of the risky assets to own. I mean, if you broke out the last 80 years between the last 40 years and then the 40 years prior to that, where interest rates and inflation are going up, it's a completely different risk return dynamic. And if you look at the reaction to bonds during the periods where stocks were selling off, you didn't get that hedge in your portfolio, from the fixed income side. So I think that, first off, you have to redefine what a risk asset is in a rising inflation environment. But if you look at the history of that, it favors stocks over bonds, but cash over stocks and bonds, which is interesting because in a higher inflationary environment, people always talk about cash being trash because you have an asset where the value is going down. That's essentially what inflation is. But that loss of purchasing power is not as bad as what you're seeing in the outright losses in some of the other investments. So it's a really, really interesting question. If people really need to take a different approach to how to think about asset allocation if we truly are in a rising interest rate, rising inflation environment. I think in that environment, I think there's no risk free, but the lower risk becomes cash. And then the thing that gets reversed is that, bonds become more risky than stocks in that environment. I mean, it depends on it depends on the bond, it depends on the stock. But I think as an asset class, that's the way to think about it. I mean, what's interesting is what people think as the most risky, type of stock, which is small caps. They actually were one of the best investments during the period where inflation was very high. So again, if the basis for your question of higher, rising inflationary environment, it really changes, the rules of the game in terms of asset allocation. Yeah, that's the big question that's happening right now. How many hikes and how big are the hikes going to be? I think right now it's hard to say because the Fed is going to be very data dependent. But I think that right now, I think it's fair to assume that every meeting is live. So I think we have 7 more FOMC meetings this year. I think every one of them is live. And I think that given their, concerns around inflation, their base case is that they're probably going to feel like they have to raise, at every meeting. So maybe that's 7 different 25 basis point hikes. The big question is there going to be any kind of a slowdown or a panic in credit markets that gets them to pause? That's very possible. I mean, these things happen all the time. And then maybe they wait a meeting. But I think that, as their base case assumption, I think that, every meeting, it's not unreasonable, and especially since at the last FOMC meeting, they said to not use the previous cycles as a gauge of what policy is going to look like today, because the inflation level is so much higher today. So I think that says, the gradual pace of inflation that you've seen in prior cycles, maybe you want to, expect that they may be a little bit more aggressive given that inflation is so much higher. Yeah, I mean, the way that the Fed is talking about the balance sheet roll-off is really that it's kind of independent from their federal funds rate policy, and so it's not going to be an extension, another tightening tool. I think maybe they'll think about it in terms of managing what's happening on the long end of the curve, right? Because if you see them raising rates and you see the long end of the curve falling, I think in the back of their minds, they don't want to see the yield curve invert. Not only does that send a bad message to market, but it also, changes the incentives for banks to lend and provide, liquidity. So I think that if they start to see the long end of the curve come down too much, they'll be much more inclined to let the balance sheet roll off more. Otherwise, if they start to see, the long end of the curve, pick up a lot, maybe they're less inclined to let the balance sheet roll off. So I think that's going to be dependent on sort of what the reaction is, across the curve. And our base case is that you are going to see the long end of the curve, sell off with interest rates rising, simply because, the Federal Reserve has cornered the market on long-term treasuries. They basically own over 50% of outstanding, 10 to 20 year maturities. As a result of all the buying they've been doing. So once they stop buying and they start to think about selling, I think that's going to put a lot of downward pressure on bond prices, which will put upward pressure on interest rates. Yeah, well, I guess it depends on how you're defining, being resolved. I think that you're already starting to see signs that the supply chain disruptions are easing. And I think you'll probably continue to see that, so almost immediately you'll start seeing that. But I think it's going to be very gradual. So I think, this is an issue that's still going to be with us, for the entirety of this year, but it will be getting less bad over the course of that year. So interestingly, you may have a scenario where, the easing of supply chain disruptions, provides a boost to growth, but not enough of an easing of disruptions that you get a big relief on inflation. And so, that's actually pretty, consistent with our view that, growth will be healthy, but you'll still see some upward pressure on prices. That would be consistent with that. I do think that this is going to continue to be a very, very tight labor market with these supply shortages. If you think about, what's caused, this dynamic is you've had a lot of people leave the labor force. So, the supply of labor has gone down and a lot of those people haven't returned. At the same time, because of all the stimulus and because of the recovery, demand has grown and the need for more labor has increased. And so you've had this supply demand mismatch, which has caused this big supply shortage that you're seeing in the labor market. I don't see any reason for that to change. If you look at the surveys that are being done about why people aren't coming back to the labor force, it's basically three things, which I think are very interrelated. It's the fact that, they have big financial cushion, stock market, as I mentioned before, stock market's up, their home prices are up, and they've got, higher wages. The other two reasons are that there's a secondary income. So you don't need two people in the household working when you have good financial cushion, so you can rely on the first primary income source. And related to that is this difficulty in finding childcare, which ties to the labor market shortage itself, but also to the fact that, the secondary earner can actually spend more time, taking care of the children. And so I think these are all they're talked about often very separately as separate issues, but I think they're all part of the same issue. So what's going to get people back into, the labor force, they need to feel a bit more desperation, right? And that's probably going to come from the financial cushion going away. So you almost need to see, a big fall off in asset prices to get really incentivize them, to come back to the labor force. Either that, or, there's a bit of a misallocation of labor, right? A lot of people have quit their jobs and moved into, exciting, sexy innovation, tech and growth companies and startups in that space. And if that bubble goes away, maybe you actually see an increase of supply coming back in traditional industries. So maybe it's either one of the two or a combination of the two of, some sort of, falling of asset prices to reduce that financial cushion, or, a collapse in, the bubble, industries that cause that labor to have to shift back to other areas. I think this is going to be a big year for pandemic recovery. So I think we are going to see, a big reopening of the economy this year. I mean, we've already, been reopening, but I think this may be the year, the biggest year where pandemic-related risk is declining, and you see a lot more normalization out there because of several things. I think one, what we've learned and seen through Omicron is because of vaccines and because Omicron affected so many people, you do have some level of immunity. Now, is that immunity going to keep you from getting sick again? Probably not, beyond the 6 to 9 month mark, but it probably will prevent you from having a severe outcome or death, which is the most important thing that people have been worried about. So from that perspective, and you've seen this with every subsequent wave of COVID, is that it's had a smaller and smaller impact on the economy and on profits. And I think that trend will continue. So as a result of all that, I think you are going to see, a big reopening of the economy this year, especially when you combine that with, improving, vaccination technology, as well as improving therapeutics. Right. In the next few months, you'll probably be able to get your hands on a pill that you can take if you get sick. And that pill looks like it's actually got pretty good efficacy. So already, even before the medicines become available, there's already a lot of immunity. But when you layer in, being able to take pill to reduce the impacts. I think, that's going to have a really big impact on people's comfort level with going out. And so I think that we will see the reopening on schedule. So I'm pretty bullish on that front. I think that's going to be, provide some nice support to the economy. It's not going to be the same in every economy throughout the globe because, there's a lot of areas that, don't have quite the immunity that we have here. I mean, if you think about China, they've been so strict about, keeping COVID contained. That's been very positive, but the negative implication is, they don't have as much immunity there. So, these are all things to consider. But as a global economy, as you consider the U.S. economy, I do think you are going to see, pretty substantial normalization this year. I continue to think that the two biggest risks to financial markets and the people's portfolios this year are one, the bubble we talked about within equity markets. Just to put that into context, if you're an investor in the U.S. stock market, if you think about the tech-heavy sectors, it's information technology, consumer discretionary, and communication services. Those three sectors make up over half of the stock market. So if you see a big correction in those stocks, that's going to have a big implication for people's portfolios. The other big risk that I think is very important is that of interest rates and inflation. And similarly there, if you think about your average person's portfolio, they probably own somewhere in the neighborhood of between 40 and 70% fixed income, depending on their age and their investment profile. Well, if interest rates go up a lot, by definition, the prices of those bonds are going to go down. And that's, that's a big portion of people's portfolios. So when you combine those two risks, the magnitude of people's holdings is so big that I think they're going to be the key defining risks, not just for the next year or two, but for the next decade. And so we're really trying to manage around those risks, given sort of the headwinds that they're facing today. Yeah, I think there's a lot of ways to answer that question. If you have $1 million in cash, obviously you don't want to sit on cash forever. I think it really depends on your time horizon and what your options are. I think if you can find a good asset allocator, a tactical asset allocator to sort of make the decision around when to add risk to the portfolio, when to take it off, then it kind of takes away that stress. But if you can't do that, I would say that maybe you want to look at diversifying your entry points. So you can pick how much that you want to get invested, based on your risk profile, and say, do it in increments, over the next year or two. So maybe every quarter you're putting part of that $1 million into the market. Maybe that's the right way to think about it if you don't have the option of a tactical asset allocator. But I think the other way to think about it is, you can simply avoid, you can invest all the $1 million and simply avoid, I was describing as the biggest risks. So, put the entire $1 million into the stock market, but keep your exposure, to the bubble and bubble related assets small, and keep your, the exposure to, the type of investments that are going to go down a lot if interest rates go up, keep that exposure low as well. And then you can probably invest the whole thing right now and do just fine.